morning, good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. On the call today, we've got Salih Yilmaz joining from London, I see. I hope you had good travels there, and excited to see you in your old stomping ground, also in London. We've got Alessio Mastrandrea joining. Then hopping across the pond, we've also got Vince Piazza on the call. I think it's been a pretty interesting week in terms of U.S. politics. President Joe Biden has dropped out of the race, and I think it might be interesting to start with a little bit of politics. I think it always feeds into some of the sentiment and discussion around oil markets, energy markets generally. Vince, let's come over to you because I know you've got some thinking on how energy sector performance tends to fare under Republican versus Democratic administrations. So give us a sense of kind of what could be in store for markets depending on how the election goes in November.
Yeah, hey, thanks, Rob. Good morning, everyone. Hey, look, full disclosure, I have no axe to grind. I have no dog in the race. I hug the 50-yard line as much as possible. So I'm just looking at this purely from an equity perspective, right? So just looking at the last 2+ decades of equity performance, what the message I want to get across is the reality versus, let's call it, the fake news, right? So typically we have this sense of Democratic administrations at the top pressuring or causing certain industries' equity performance to lag. And when you look at energy, it's really not the case, and just going back 20 some odd years, and just looking at just performance, equity performance, not adjusting it for any items. This is pre-dividends, right? So look at the S&P or the spider for the S&P, and look at XLE, which is the energy ETF. Under the Obama administration and presently under the Biden administration, energy actually outperforms. So, to suggest that the industry is at a risk. Now, the other thing that folks tend to offer up is, well, that's because there are restrictions on production, and while demand still tends to rise, you're tightening balances. That's also not necessarily true because we hit significant highs in production during the Obama years, when every year we were having this fight about budgets and the incentives for the energy industry. And oh, by the way, those were maintained in every budget. So there's a lot of bluster around this topic. And so, that seems to be the influx of traffic that we've been getting hit with since the announcement this week. But I am not at all concerned for the industry on a relative basis. Now, the industry is going to be challenged because, you have organizations outside of the U.S. that have tended to control or engineer markets. But here in the U.S., just take a look at it. Just do the 8 years of Bush versus the S&P and energy, Obama versus during Obama, XLE versus the spider, and every year, every period, not every year, but every period, energy equities end up doing better under a Democratic administration than a Republican administration. This year, though, I will say this: there's a caveat. This year, Um, the XLE is actually underperforming the SPY. So, I think there's some other issues involved there. But just looking at it just on a simple return basis, excluding dividends, right? Just looking at a simple return basis, equities tend to do better under Democratic administration. Now, watch my phones blow up in the next 10 minutes, but that's just the reality. And that's okay. There's nothing wrong with that.
Vince, I feel like that's such a contrarian message coming from you, but I love it. Salih, let's come over to you. Get your read on some of the oil energy macro. Vince certainly alluded to OPEC. He didn't name them, but what's your sense? Does the election matter for kind of the global oil space? I mean, you've had a big report earlier this year on geopolitical scenarios for the oil market. It wasn't focused on the election, it was more focused on conflict in the Middle East region. But give us a sense. How do you read the tea leaves based on some of the maneuvering we're seeing here in the States?
Sure. Thanks, Rob. So when I think about potential impacts of elections, and last time I was on the call, we were talking about a potential Trump administration and what that might mean for OPEC policy and some of the member nations within the group. And the first thing that comes to my mind is Iran and sanctions on Iran. I would think that there would be stricter sanctions on Iran. That's what we saw in the previous Trump administration. Of course, it came with some exemptions for certain countries that import a lot of Iranian oil, but I think it's safe to assume that there would be stricter sanctions or stricter enforcement of the existing sanctions of Iran. But then on the flip side, what might be the impact on OPEC Plus in general? In one of the latest interviews that Trump gave, I believe with Bloomberg Business Week, he said he has spoken with Saudi Arabia's MBS in the past 6 months. He said they'd like each other. So it could be that he might have some more influence on OPEC Plus policy in the sense that he might push them to start tapering the current output cuts, perhaps a little bit earlier and perhaps a little bit more than they otherwise would, which would of course be pressuring prices down. And I think potentially Trump would be aiming to get prices at the pump down as much as possible. And on the geopolitical side, yeah, I mean, we didn't really mention in our deep dive anything on the election per se, but geopolitical risks, especially in the Middle East, are still a factor when it comes to the oil market and when it comes to oil prices. And when we look at the oil macro right now, I don't think there is much of a geopolitical risk premium attached to the prices right now. And I think what's driving the market currently is more demand. And there's a lot of confusion. There's a lot of uncertainty around demand at the moment. On one side, we're looking at China and we're getting very mixed indicators, and there's a lot of uncertainty there. But then some preliminary reports are showing that crude stockpiles in the US may have fallen for a fourth week straight. So that's showing us a little bit more of a positive outlook, at least in the US. And the third quarter generally is, seasonally stronger in terms of demand, especially in the US. So a mixed demand picture, and that really the headlines around demand seem to be moving the market and oil prices at the moment. And one thing to note, of course, again, OPEC Plus, they do still have a tight grip on supply. They still do have the output cuts in place. The last thing they've told us, the last thing they've announced is that starting from the fourth quarter, they will start unwinding those cuts. These are, of course, subject to change. We don't know if they will actually go ahead with that. That will probably depend on where the market is at the end of the third quarter. So a lot of moving parts, but currently Brent is sitting near $81 a barrel, which again, on the one side shows there isn't much geopolitical risk premium left, but it's still, I think demand is still holding up well enough to keep prices above $80 a barrel.
Salih, since you mentioned demand, I just want to probe quickly. Out this morning from our colleagues on the automotive team is a deep dive on electrification in the automobile space. The title of the report is Tesla BYD Race for BEV Lead, but Gas Wins. I think their expectation is that ICE automobiles, at least for this current decade that we're sitting in, are still going to be quite dominant. What's your sense on the sort of calculus around energy transition and electrification, how it feeds into the oil market?
Sure, yeah. I mean, road transport part of oil demand, I mean, is a big chunk of oil demand. And, we've been talking about both the EV adoption and fuel efficiencies as two things that will drive the road transport part of oil demand gradually lower. And again, I mean, fuel efficiencies we've been hearing for perhaps a little longer than EVs, and we've been promised a lot of fuel efficiencies, and we haven't really gotten them. And I think we've had technology in the internal combustion engines bringing a lot of efficiencies, but at the same time, I think people started preferring bigger cars, SUVs that just tend to be, I mean, they are bigger and end up using more fuel. So we haven't really seen much of an impact from fuel efficiencies. Of course, with EV adoption, we are seeing this accelerate in places like Norway, in bigger places like China as well. And of course, this is going to have a dent on oil demand. But when you look at the bigger picture, road transport is a big part of the picture, but not all of it. And one thing that's growing and is expected to grow is on the lighter end of the barrel, which goes into petrochemicals. Because as we might be losing a little bit of oil demand from road transport, we are actually getting more from the increased use of plastics, increased call for crude oil to convert into things like naphtha, and then eventually into petrochemicals. So I think, and again, this is what we discussed last time I was on this call, this divergence between different agencies and what they're expecting in terms of oil demand. The IEA thinks oil demand will peak in 2029. And on the other side of the coin, OPEC thinks oil demand will keep growing all the way to 2045. And of course, I think outlook of EVs and outlook of EV adoption is probably playing a big part of the difference in opinion when it comes to oil demand in these two different agencies.
Vince, I want to tie this concept into the political discussion and come back to you, because I'm just looking at their sort of intro page and exec summary. And part of their research, they did some consumer surveys, and it seems like consumers are pushing back, at least in Europe, on some of the ICE bans that are in place that would basically require folks to get EVs. Are you watching any of that conversation as it pertains to the U.S.? I think there's probably a lot of federal discussion about that $7,500 EV tax credit here in the States.
Yeah, so here's the reality. For me, I not long ago rented an EV just to try it out. And while it was relatively inexpensive to rent, trying to find some place to actually charge it has been extremely difficult. So whether or not I could buy it and utilize the credit, I still have to find a place as I'm traveling to plug in somewhere and charge my vehicle. I think I went through an ordeal that I'm not going to get into here, but trying to find a charging station in a place like New York City, the bluest of blue, was extraordinarily difficult. So credit or not, it's how can you please the consumer and make it more efficient for the consumer to get what they need to get done. So in this case, in another case, I rented a hybrid not long ago. Relatively easy to refuel that thing. Okay, so I think credit or not, it's the impact that further downstream that these vehicles have had and will continue to have on a decision-making process of the average consumer. I'll just leave that there.
Vince, I got to respond a little bit. So one, I agree with you. I was on a vacation last week in California. When I go on a vacation, I always rent an ice because gas stations are everywhere. I don't want to deal with where's the EV charger at. It's too complicated right now. So I'm fully with you. Now I own an electric car. It's great. Was on a date last night. Don't think she cared about the fact that it was an EV, but the autopilot feature, like I let it drive us home, and like it was like, no hands, So that was impressive. Whatever, doesn't matter. If you go on holiday, don't mess with the EV. I think you wanna have a nice for now, just because it's easier. All right, Alessio, let's bring you on the politics discussion. You and I put out a note on looking at this transition from Biden probably to Kamala Harris, but another Democrat looks like they're going to be at the top of the ticket. What's your read, particularly as you think about the wind and solar space?
Yeah, thanks, Rob. I think the findings of our note was mostly that things are going to remain status quo should Kamala Harris A, get the nomination, and B, win the election. A big key of the Biden administration was the passage of the Inflation Reduction Act. And on the anniversary of the passage, Kamala Harris went around doing speeches celebrating the success of it. She spoke at COP28 in Dubai last year, saying that the U.S. is going to commit to 3x of renewable capacity by 2030. So I think she's on the clean energy transition wave. And interestingly, we put together a map of all the US-based manufacturing sites that have come up with clean energy production since the Inflation Reduction Act passed. And we saw that it was about a 50-50 split between red states and blue states. So this really is a bipartisan piece of legislation that is helping everybody.
Okay, very interesting. Alessio, I think we'll start with you here because I think we are in the midst of earnings season kicking off, and I think everyone on the call can speak to that a little bit. We had in our space, Enphase went after market yesterday, and for anyone who doesn't know kind of the narrative on the solar space, it's been a challenging time, to put it mildly, and the companies that have had exposure, particularly on the residential side, have been going through a quite difficult patch. So given that as the context, what do you make of how Enphase fared in 2Q? What do you make of their guidance for 3Q? And kind of what does their sort of turnaround story look like?
Sure. So big piece that came out yesterday of their guidance is their channel inventories have been cleared. So the last couple quarters, they were under shipping demand by about 90 to 100 million a quarter. They said at the end of Q2, that's cleared up. But at the same time, their guidance was a bit muted. I think they're being a bit conservative on sales just to see like how quickly this does ramp up. The best part to me, though, was the growth of their battery. So shipments grew 40% sequentially. And they're going to keep growing at a very fast pace throughout the rest of the year. And we are even noticing attach rates as high as 90% plus in California. Interesting tie into the political side, though. They did say that no matter who wins the presidency, they do expect the tax credits and things to remain status quo, with the caveat that they still report results with and without tax credits, just so for the sake of transparency.
Yeah, very interesting. One of the political hot potatoes is what could happen to the Inflation Reduction Act under a change in administration. And that policy got the worst name in the world, but it's quite meaningful for any of the names in the solar or wind space or EV space. And if anyone wants to go deep on that topic, I'd highly recommend checking out a big report that Nathan Dean put together. He's our senior policy analyst based in Washington, D.C., he can go super deep on that topic. He's joined this call a couple times in the past. We'll get him on again soon to talk more about this, but just look him up on bio or reach out to any one of us if you want to go deeper on that sort of tax credit sort of landscape and kind of run the scenarios to think through how things could evolve depending on which way the election goes. Okay, let's switch gears. Vince, you've had a couple companies report. You've got some reacts out this morning, I believe on Matador, and I'm drawing a blank on the other one. But tell us what you're hearing from your space.
Yeah. So as part of our duties here on the U.S. equity side, we also help out on sector strategy work, and we're in the process of finalizing the last few notes ahead of quarterly results. So in general, so far, what we've heard is pretty consistent. Discipline seems to be holding. Producer discipline seems to be holding. Cash flow is looking a little better. I think the approach that we're going to hear on conference calls is for a more guarded view on natural gas in 2Q. We tend to have more of an optimistic view heading into the winter season for natty gas, despite the fact that production is rallying back pretty hard. Storage is actually still shrinking, and that's because we finally have some heat across the U.S. It's gotten a little better, but for the most part, we're still bullish on nat gas in general. We're back to cash break evens in a lot of the space, in a lot of the regions. So we think the space on a risk reward basis, the commodity itself, looks better positioned, and historically we've always bounced off these levels. So I think it's feels better from a relative basis more broadly.
Okay, let's swing across the pond. Salih, I think you've got Repsol today. Give us a sense of what is going on there, and Aramco. Some of your other big names are coming up soon. So, what's in the cards?
Sure. I think for oil majors in general, refining is what we need to watch a little bit more closely. We've been talking about how refining margins are very likely to normalize through this year. This is what we've been writing on our mid-year outlook as well, and that is what's happening. But when we look at Repsol, which, as you said, reported this morning, the drop in the second quarter refining margin is actually sharper than what most analysts were expecting. So we are seeing weaker downstream, weaker refining, and Repsol is not going to be the only one. When we look at Exxon, I think among the US majors, a bit of a more downstream bias, and they've already said that their quarterly earnings may be down. The impact just from weaker refining may be up to $1.5 billion. And we also had BP here in Europe guiding to sharply weaker refining margins as well. When we look at Repsol specifically, upstream kind of came to the rescue in the second quarter. They had significantly lower expenses in upstream, lower tax costs as well. So they've done okay. I think the share price was down earlier, but is up later this afternoon, and they are announcing a new share buyback program of 20 million shares, which is, I believe, less than what most analysts were expecting. They're still continuing their share buyback program, which shows that they are still in a good financial position, but less than initially anticipated, which shows that the conditions are starting to soften a little bit. So when it comes to Aramco, they report early August, and their profit is actually expected to be slightly higher compared to the same period last year in the second quarter, and that is despite their output being lower, because as you know, they have to follow the directive that comes from the government, from the ministry, and Saudi Arabia being the de facto leader of OPEC Plus, and they are they continue to deliver these deep output cuts. So their output is limited at just below 9 million barrels per day, but benchmark prices this year have held up at relatively favorable levels. We know that they're doing their base dividends and the special dividends. Their dividend yield right now is at 6.8%, which is very competitive. I think it's the highest right after Italian Eni. But when we look at what they're expected to be generating in terms of cash every quarter and their dividend expenses every quarter, I mean, they are now paying about $31.1 billion of dividends every quarter, which is lower than the cash they're generating. So at this rate, their net cash position would be falling by between $8 to $9 billion every quarter. So I think they would only extend these special dividends if they are comfortable with having a net debt position pretty soon rather than net cash position, and seeing that net debt position grow. And when you compare their financial position to some of the international majors, usually majors are comfortable with 20 to 30% gearing ratio, and they have a long way to go until they are in that range. So, but also with Aramco, refining is one thing to watch, just like with all the other global majors.
Fantastic, Salih. I think it's wonderful, by the way, that you and I woke up this morning and clearly decided to wear roughly the same shirt. So good to see that. We must have been cosmically aligned. Alessio, let's switch over to you. One of the things that's been in the news in energy land is the Vineyard wind project offshore in Massachusetts. For anyone who hasn't seen it, there was a malfunction of one of the turbine blades that was being installed, and it fell into the water, and it's been washing up on the shores of Nantucket, and so it's quite pristine beach real estate. Give us a sense of what's going on there, and what it might mean for the offshore wind business.
Yeah, this one's been an interesting one to follow. Like, it's terrible that this happened. The debris is washing up on the shore. It's caused the beaches to close. It's hurting the local economy. It's preventing fishermen from doing their job. But in the grand scheme of things, this $4 billion project, which represents about 800 megawatts of capacity, it was powering 400,000 homes and businesses. And if you do the math for the 25 years of the useful life that's expected from these turbines, that comes out to an investment of about $400 per household to power these homes with clean energy and reduce emissions by 1.6 million tons a year. So I still think it's a net positive, and I don't think it's going to do much to stop the growth of offshore wind this year, which I think is starting to pick up quite a bit after a few years of a bit of a lag.
Yeah, it's very interesting. What is the rough range for offshore wind costs? Because I know some of the projects, there was a project in New Jersey that basically they had to go back to the regulator because they had essentially underbid, and the project was uneconomic based on the agreement that was contracted, and so the regulator had to come back and essentially up the price. But ballpark figure is offshore wind expensive, cheap? Is it going to get cheaper? Just give us a sense.
I mean, it's about twice as expensive as onshore wind, but the capacity factors are just massive. These turbines that GE installed, they're 12 megawatts, and one rotation of a blade can power a home for 2 days.
Stunning
So
numbers.
prices have gone up a little bit, but the trend is that they've come down quite a bit over the last 2 decades.
Yeah, I think it really does highlight this experience. There's no perfect form of energy. It's kind of wild to see sort of like a debacle from the wind industry, and obviously oil and gas folks have known it for a long time. Sometimes mistakes happen, and there's no you can't really apologize for that. Nobody wants to live by something that's messing up life in their own backyard. But with that, okay, I think Vince, Salih, any final words from you guys before we round it out? I know we're a couple minutes over, but if there's anything burning that we didn't get to from your franchise, speak now or we'll get to it next time.
Earnings season is upon us. Stay tuned.
All right, fantastic. Sorry for the delay in getting started here today, everyone, but really appreciate you joining us. We are generally holding these calls every week, unless it's a major holiday or something like that. So join us Wednesdays at 10 a.m. New York, 3 p.m. London. We rotate through the BI crew. We've got a great set of analysts who know a lot of things about energy. Sometimes we bring on some of our colleagues who know things about other parts of the equity or commodity universe. And occasionally we have an external speaker as well. So anything you've heard discussed is all based on research that we publish on the terminal. If you don't know how to find our research, just reach out to any one of us. It's pretty easy to get you pointed in the right direction. And we're happy to talk more deeply on any of the topics or companies that we've discussed here on the call with you. So just give us a shout if you've got any follow-up, and we look forward to being in touch. Have a great rest of your week, everyone.